Everybody, we're back. It's another Wednesday. It's another Truth or Skepticism. Except this time, Dylan, I'm in the UK. You're in the you're in what is Italy? You're in the Eurozone, I guess.
I'm on the continent. They call it the continent.
The continent. That's better.
I'm continental. Yeah. I'm continental.
Yeah, I'm very I'm kind of a little ignorant when it comes to that.
Are you kidding me? You, sir, are a locomotive. You did three shows in Texas. You flew yourself to London. Well, you probably didn't fly yourself. You probably had someone else fly on your behalf, but you got on the airplane. And now you're running your London junket. You're going to go back to Chicago. I mean, I
didn't cook my own meal on flight, so I'm good.
Well, you had time probably to think on the plane about the hyper concentration of this market. We spoke last week about the NVIDIA situation last Wednesday, which I believe was actually NVIDIA earnings day. And not that we want to rehash that, but there's obviously a tremendous amount of data about, I don't know what you call them, the Magnificent Seven. You can call them Amazon, Apple, Google, Meta, NVIDIA, Tesla, call them whatever you want. At the end of the day, you can call them the stocks that are up 70% on average this year in the S&P 500. And then the other 493 stocks in the S&P 500 as of this moment are up about 4%. So, and again, not the first time we've seen hyper concentration. In the 60s, you had Xerox and Whirlpool and IBM, whatever, and the Nifty. So there's always been a few companies that really, outperform. Is this different than that in any way? Is this the same as historical? And is it a point of either, is it good? Is it bad? Should we care?
Well, I hate to disappoint to start off with, but instead of spending my 9-hour flight thinking about hyper concentration of markets, I think I watched about 90 minutes of South Park and fell asleep. So I didn't exactly work my brain too hard. I just want everybody to be, I'm not on 100% of the time.
You don't want to misrepresent.
Focus. I had just done a couple of hour seminar in Austin, and the last thing I wanted to do was talk about. I did write a few emails, but I didn't want to really talk about markets in the middle of the night. So no, but I think the concept of concentration is actually pretty fascinating, but not for the reasons not totally for the reasons that you just brought up, because I don't think concentration as it applies to markets is really that unique. I think concentration is something that we deal with at the top of the funnel, like they say, or whatever we want to talk about, whether it's concentrated wealth or concentrated activity or concentrate, like the
biggest tennis players get the biggest money, the biggest movie stars get
everything. Everything in life,
supermodels.
Is the market really any different than, let's say, most businesses? It's something like the 95-5 rule. They used to say 80-20, but it's not even 80-20 anymore. Most businesses are like, you make 90% of your money from 6% of your customers. So if most businesses make 90% of their money from 6% of their customers, and this even stretches down to almost to create things that you wouldn't even think, which is the case, might even be a restaurants or something. But for the most part, especially in the financial service business and in lots of other businesses like financial services, it's a tiny little percentage of customers that generate, almost all of your revenue. And I think that works in manufacturing. I think that works, in service businesses and everything. And if you put that into kind of perspective, is the stock market any different, or is it just kind of, just the kind of the micro version and of what you're looking at everywhere else in the world? I mean, it's also like the concentration of wealth. It's also the concentration of power. It's also the concentration of military. I mean, when you think about just, it's also the concentration of disease. I mean, when you start to, realize this, you're like, okay, I'm not sure that the top 6, 7, 10 stocks, we sometimes like to say 15 or 20 stocks that completely dominate the market, are no different than any other business, service, or manufacturing anywhere else in the world at any point in time. So,
and I don't, but I get, no one would, I don't think, I'm not going to disagree with that for sure. I think a lot of people wouldn't. The obvious liability of that structure, whether it's a restaurant, whether it's doesn't matter what the business
yeah,
is that it implies a certain level of instability or fragility where,
yeah,
if the 6% of the customers that support my brokerage company, or the 6% of customers that support my restaurant, or that 6% of whatever the stocks that are my returns in my portfolio, to be literal, that if there's a change at Amazon or a change at Nvidia or a change at, that the hyper performance of hyper concentration comes with a lot of risk of fragility
yeah.
on the other side.
They refer to it in business. It's essentially a single point of failure. And when we think about, there are many multi-hundred-billion-dollar businesses that essentially have, you could argue they have many single points of failure. And there are definitely lots of businesses that are, between 1 and 10 and 10 and $50 billion that have single points of failure that rely on, a single customer or single something. And I think the idea of finding, a diversified economic base is incredibly tough. Like when people, one of the arguments that I always make about, one of the things I love about Chicago is, and I've made this argument forever, is that it has the most diverse economy in America. It has no market share, that it has no revenue share, no economic share that exceeds 13 or 14%. So it is incredibly diverse economically, which gives us this really a lot to fall back on. There's no other city like that in America, which is why Chicago is a strong city. But you end up in many cases, like you've seen it happen with countries before. In 2011, Greece, Italy, these are countries that rely totally on tourism. And there's not just those two countries. There's a million. We saw us go through it, during the pandemic, and all the different businesses that relied on, that.
Well, you're seeing it with Hawaii right now, with no one going to Maui because of the fires. The entire island is now in an economic crisis, not because of the fire, but because the fire created a dynamic where people stopped going on vacation to Maui.
Yeah, and Hawaii. I mean, it's going to be,
and Hawaii.
It takes it. This is the kind of stuff, you saw it. Well, this is something that. So I guess the point I'm making is that I'm not sure if this is a stock market problem. I don't know
but is it a problem?
Well, considering that for centuries we have been dealing with concentrated risk everywhere, in every business, from real estate to financial markets to service markets, like production and
the job
manufacturing markets, everything else.
The job market in Los Angeles in the entertainment industry. I mean,
of course. And I mean, you can argue, you want to make some, there's some great arguments out there. Like, just look at Silicon Valley and look at the state of San Francisco right now. San Francisco freaks a lot of people out. It's in, I don't know how San Francisco is going to recover. It's in a state of turmoil. And, you can blame a lot of that on, again, being a single point of failure in the tech space. You go up too much, and then when it turns around, you go down too much. And that's no different than capitulation in the stock market type of thing.
Yeah, and I know you've said this because I've been doing it myself actually the last few weeks, which is looking at the NASDAQ up whatever it is, 29% for the year. All of it really driven by these 5, 6, 7, 10 companies. It's very seductive to think that being at least short premium, i.e. call spreads, or overtly short those names for the rest of the year, it almost feels, it's so attractive, and I so distrust my own instincts that I wonder if I'm missing something. In other words, it's how do you not, the pot odds being neutral or net short those names for the rest of this year seems difficult to argue against.
One of the things that I've always loved about what we do, Dylan, at Tasty, and one of the things that why I think this firm is so special is that we actually introduce a finance through a different lens, through a completely different perspective, which essentially says, as a Tasty trader, you may or may not make money. That's up to you, but you're definitely not going to get caught up in the concentration of 7 stocks. And so therefore, by definition, it's a process of, diversification, which I think is crazy important, which I don't think people give enough credit for. There was an article this past weekend that one of our viewers sent me. I'm not actually sure if it was written this past weekend, but one of our viewers sent to me, so I read it. And I think it was in Fortune magazine. And it was basically talking about young people, and they had and their desire to trade. And the person writing the article, who was really pretty clueless, was making the argument that this is either good or bad. It could be disastrous based on their results. If the market turns around and goes down, it's going to be a disaster. If the market goes up, maybe it's going to be good for them, but they don't understand why. And is this too risky and all this kind of stuff? What the person didn't understand is that trading, besides everything else that it does for challenging and decision-making, everything else, it is a true diversification to traditional concentrated and to traditional concentrated investing and single purpose tunnel vision, with respect to finance. And so they completely missed it. And I think it's one of the most fascinating parts about trading is that we actually have built a vehicle for strategic thought as much as it is for anything else. It's just, who cares? Who cares that it's the markets? If there were liquid sports markets or liquid political markets, we could use those. Who gives a crap what the markets are? These happen to be liquid, but it's the strategic side to it. It's everything else that comes with it. It's the complete, non-traditional alternative route that's so interesting to me.
At this particular moment in time, going to my original question, how do you interpret the current performance of the hyperconcentration? In other words, I know you're a person who you like at extremes and all these things. Like, do you see the divergence of these names at this moment as being unusually concentrated, or is this?
Well, I think it would be, listen, anytime you get the first 6 or 7 months of the year and you have the NASDAQ up 44% or whatever it was, 42%, I think it'd be impossible to argue anything but that. But do I view that as like, is that a red flag? Of course. Is it like, can I see the sharks 6 feet offshore? And the answer is no. I don't know. It's definitely a marketplace that I don't want to be in. So if you ask me, am I long, Tesla, Nvidia, whatever, all the AI stocks, all these NASDAQ stocks, the answer is of course not. But I'm also not giant short them. I'm just trading them.
Trading them in the sense that you're selling premium outside. Typically you're a premium seller one way or the other.
Typically, but we have a lot of stuff. We're actually deploying a lot of different strategies in them right now. So because volatility is kind of low because they just had earnings, so we're deploying multiple strategies. But listen, opportunity is, there's a big difference between opportunity, which is what I trade because there's opportunity there. I don't trade necessarily, like I'm not trading Meta because I think it's going up or down here. Nvidia, now that it's sold off $50 or something, I'm not trading Nvidia or Tesla that's sold off $75. I'm not trading Tesla because it's $75 off its highs or whatever, and I think it's going higher or lower. I'm just trading based on opportunity. Like you just mentioned Hawaii before. The last couple of days I traded Hawaii Electric, HE. And the reason I traded it is because, it was 300% volatility, got down to $9 or something. It's just, we seek noise, we seek opportunity. That's what traders do. I'm indifferent to what the product is. I couldn't care less.
But the point is, I know that, but I'm saying in this particular moment, yes, the Magnificent Seven, I'll call them, are a red flag, but it's not notably Well, I'll say it's interesting, but it's not alarm. It's not a 5 alarm fire, particularly considering that there has been the selling of the last few weeks.
It's not 2000. It's not the summer of 2008.
Yeah,
It's not the summer of 1987. You know, where it was much. Here, a better example. It's not 1999. You know, or it's not the. You know, it's not a crazy move like, you know, with some of the meme stocks. It's not that. This is not GameStop trading at 500. You know, I mean, the fact that Nvidia doubles or triples is not the same as GameStop going from $6 to 500.
I'm gonna do the transition for me in this discussion, and it goes a little bit because, as you know, I've been paying more attention to some of the sort of ridiculous biotech names. Some of which have, you know, they're basically biotech equities, especially, you know, early stage biotech equity is just another version of a high implied volatility call option, basically, because it's a worthless piece of equity, but for the chance that the drug gets approved or sold or whatever for $1 billion. And because of that, paying attention to that sort of piece of the market, I've watched the entire biotech sector the last, whatever, 4, 5, 6 months just get face pounded, right? Like, I mean, with the exception of 1 or 2 companies that have done some particular thing. And it's a sort of, in my opinion, a classical example of, you know, as in a rising rate or in a high risk-free return environment, whether it's 5%, 6%, 4%, why on earth would you accumulate risk in something as preposterously risky as early stage biotech when I can get 5% for no risk? And so at the same time, we started to see Bitcoin come off. And I'm just interested in your point of view, that whether it is, I'll set aside the biotech example unless it's particularly compelling for you, and I'll focus more on Bitcoin. To what degree is Bitcoin at this point little more than a derivative of either the risk-free rate or the perceived relative returns of the equity indexes? And as the equity indexes get cheaper or sell off, I don't know about cheaper, but as they sell off, and as rates hold, or, you know, as the Fed doesn't backpedal, they're like, oh, well, we're not going to change policy. If they're confirming what everybody already knows, but all the same. To what degree is Bitcoin little more than a function of perceived relative returns, either in fixed income or in equities?
Well, there's 2 questions there. On the first one, with respect to biotech, I mean, to me, the answer is simple. The reason that people invest in biotech is, you know, I mean, usually it's because they like the story, you know, they get emotional about the story.
They believe they know something. They're like, this.
Yeah, they definitely believe they know something. But the reality of the markets don't care that people believe they know something. The markets actually are priced to perfection based on implied volatility. And the reason that biotech stocks trade where they trade is because the asymmetric opportunity in biotech stocks is not some multiple of some very, you know, marginal multiple of risk-free rates. The reason people invest in biotech stocks is because if risk-free rates are 5%, they think they're going to make 5,000% or 500. You know, like 500 is not even enough. You know, so this is a play, you know, to risk 1, you know, to make 1,000. You know, risk 1 to make 500. So the asymmetric opportunity in biotech, you know, whether it's cancer, you know, cures or whatever they're doing, that's why people play biotech. It has nothing to do with you're hoping for, you know, risk-free rates are 5%, so you're hoping for 15% because you're taking, you know, outsized risk. No, that's not it. You're taking asymmetric risk that is a crazy multiple, and that multiple in the marketplace is being discounted. That's why you're doing it. So in other words, your chances of, if you're right, you make 500 times and you're only paying 200 times for it. That's the discount. So that's why people do it, which is okay if that's what you want to do. The other side to it, Bitcoin, is to me a lot more interesting because this is something. This is not a shot. Like, this is not the same kind of shot that an FDA approval is, or some kind of drug, and we don't know all that kind of stuff. This is a proven technology, and depending on what this technology ultimately becomes and how it is adopted into the various marketplaces, and for many different reasons, whether it just becomes an asset class like gold, or whether it becomes actually something that's, used for, as a substitute for, or as a complement to different currencies, who knows? But if it becomes even remotely transactional or something else, and there's so many connections to, to blockchain and everything else, that I think it's probably, obviously it was priced very high for a very long time, for about 8 years. It was trading at about, 2.5 times the volatility it should have been. Now it's priced at implied volatility less than Tesla. I think it's a really interesting product here because it has no correlation to the stock market. So to me, there is no difference from trading, I'm in London right now. There's no difference from trading the British pound at let's say implied volatility in the British pound is 8, and implied volatility in Bitcoin is, let's just say, 40, just as an example. So what I'm doing is, if I trade $10,000 worth of Bitcoin or $10,000 worth of British pound, I have, 5 times less risk trading the British pound and 5 times more risk trading Bitcoin, but it's the same exact trade. Like each one is just, neither one has a great derivatives market, and each one is a directional shot, which is basically just 5-to-1 IV adjusted notional. So I don't look at Bitcoin today any different than I look at any other tech play. And if you ask me, what do I think about Bitcoin relative to AI as a tech play right here, I would say I probably like Bitcoin better, just because it's cheaper on a relative basis, I think.
And again, that's what I was going to get at, because when I talk about cheap or expensive, or rich or versus cheap, with AI, I can look and I can say, well, NVIDIA's revenue is X and its margin is X and its stock price is X and the multiple is X and it's too much, the multiple is too high, or a biotech company for that matter, or anything. But what are you looking at in Bitcoin to get to inform you as to whether you believe it's rich or poor, or cheap or expensive?
Well,
relative to what?
Well, as a trader, what you look for always as a trader, Dylan, I think, is you just make, you have this subjective or objective idea that something is cheap or expensive relative to where it has been and relative to where you believe that technology trades. So, for example, if Bitcoin used to trade with an implied volatility of, let's say, 130, 140%, and now it's down to 40%, you're recognizing, okay, that 40% on a, let's just call it a $25,000 index, is basically just, that's a $10,000 move over the course of next year, right? That's all it is. 40% of 25,000 is a $10,000 move higher or lower. So you already have your Bitcoin range set up. The markets, I'm an efficient market theorist, so I trust markets. So the current range in Bitcoin, based on its current pricing, which is undeniable because it's fact, because it's tradable, is 15,000 to 35,000. That's the market. It's currently trading 25. It's 15 to 35. So now you know what your market is. But yet you'll go look at a stock like NVIDIA, okay, and based on its implied volatility over the course of the next year, the move in that stock is probably, I don't even want to guess, so I'm going to give you the actual number, but the move in that stock over the course of the next year is $171, and it's currently trading at $450. So the range on that stock is going to be 625 to, let's call it, 275. Like from a theoretical standpoint, I feel like there's more risk right now. There's about 15% more risk. I'm just doing this in the back of my head, but there's about 15% more risk in NVIDIA, which I think is at the high end of where it's going to be, versus Bitcoin, which is on the low end with 15% less risk. So it's a more attractive trade to me. That's how I do things.
I follow you with all that math, with the one question, because you taught me this. Stock prices, or prices, in the case of Bitcoin,
sure,
have no reason to mean revert.
Yes.
right? Implied volatility, as you've said a billion years ago and a billion times, mean reverts.
Yeah.
Prices don't.
Yeah.
So how useful? So you give it these guideposts, whether it's the NVIDIA guidepost or the Bitcoin guidepost.
So the
sure, the
guideposts have nothing to
range
do with
may
mean
indicate
reversion.
the magnitude of the potential.
Yeah, but those guideposts are not about mean reversion. That's just those are the guideposts. Those are ranges.
I get it. So then how do I, so understanding though that that's sort of the scope of the size of the potential move is what it is, plus or minus 10 grand or plus or minus 175 bucks, we'll say on NVIDIA, gives you no indication of direction.
No, that's what's trading. That's why it's called trading. So you might be bullish, I might be bearish, you might be bearish, I might be bullish. That's trading. Or we can play it neutral.
Or is that gambling? I mean, where's the line between trading, which theoretically is some informed speculation, and me and you betting $1 on where the housefly is going to land in the kitchen?
Well, I mean, people like to think that there's, that people like to think that they have an opinion based on certain things. I'm not going to tell you what. I mean, each person has different things. Some are fundamental, some are technical, some are just, they're macro. I can't say. Some are tape related, like mine. But the difference between gambling and markets is edge. Gambling, there is no edge. There's no positive drift to gambling, and there's no real emotion. There's a lot of different things. Emotion doesn't move gambling markets, and there is no edge. And so I think it's different. But if there was no VIG, it would be very similar.
Mm-hmm.
I mean, the markets have no VIG. They're essentially trade for fair value. So in a world of fair value, if you think you have, again, and their markets are also potentially strategic. Gambling is not strategic. So it's emotionless, it's not strategic, and it has a negative edge. So I that's the difference.
Bottom line, you'd rather own Bitcoin than NVIDIA.
At today's price, yes.
Mm-hmm.
I'd rather own China. I'd rather own some Chinese stocks than some American stocks.
But you wouldn't be openly short NVIDIA.
I am not openly short NVIDIA. I don't like, like there's other ways to play NVIDIA. I mean, maybe you're long Intel, short NVIDIA. Maybe that's the better play. I don't know. But like at these levels right here, NVIDIA's been a very difficult trade in 2023 because it's had such a crazy move. My goal for the rest of the year in NVIDIA is to and we've been run over in there based on earnings. So my goal is to continue grinding it out in there, like with some short premium plays and to stay pretty neutral in there. And I'm okay with that.
Mm-hmm. Right. You're just trying to fill in the hole with small buckets.
Yeah. I mean, sometimes stocks win. NVIDIA won this year.
Okay. Enough with the trading discussion for the moment and on to the essence of corporate culture. When a company is openly corrupt in its culture, and I'm thinking about Wells Fargo, and I say Wells Fargo is openly corrupt because they've consented. I mean, when you openly concede to the fact that you have a history of opening false accounts in order to charge false fees and you pay penalties for doing that, I don't think I'm overstating it to say that that's a corrupt culture or that it was a corrupt activity. I don't know if it's a corrupt culture, a corrupt activity. And they had paid a big fine. Wells Fargo, again, recently in the past few days, again, paid another fine, as far as I could tell, drop in a bucket, $30 million. I look at a lot of these fines, whether it's banking fines or tech fines like Facebook, they'll find them not so much as penalties as, a slight margin impairment. It's like a slightly elevated operating cost more than it is a deterrent to the business model.
Agreed.
But when you see what amounts to, or at least what appears to be a reoccurrence of a previously fined behavior, in the case of Wells Fargo, suggest accusations of opening false accounts yet again in a different context. it'd be like finding Volkswagen once again lying about fuel efficiency, right? Where they are already, or it'd be like finding Uber, once again, going back to the Travis Kalanick like madness of bullying and whatever. I guess what I'm getting at is there a point where, and I'll just use Wells Fargo as an example, where remedying or correcting what the business model is basically impossible, that the culture is so one way that it is not fixable, that there is no fine that would fix that?
Yeah, it's a great question because of major U.S. companies that have, let's say, I mean, obviously, at a very small, you know, penny stock or a private company or a small cap, there could be a culture of, deceit, criminality, all that kind of stuff. But Wells Fargo, I'm not sure exactly what the market cap is, but let's say it's over 125 billion, I think, easily. So here you have a company that's, one of the largest financial institutions in the world. And, I mean, should they be dealt the death penalty is really the question. And they have a culture that you would like to think, that years ago was uncovered as dangerous, criminal, unethical. They had all these different things. And maybe it was just a small percentage. I'm sure it was just a small percentage of the people, but there's clearly something going on there. And the fact that they haven't been able to clean it up, although I'm sure they say this is probably something that was, from years past and lingered, but the fact that they haven't been able to clean this up is really amazing. It blows my mind a little bit. Because God knows they probably tried. And also the fact that they've been protected by very large investors, specifically like Warren Buffett and Charlie Munger, who steadfastly stood behind that company, not believing that, it's almost like, I hate to use the analogy of Joe Paterno standing behind Jerry Sandusky, but I mean, it's not too dissimilar, of not wanting to believe.
Or I would just say a parent with a child would be the sort of class, like where mom or dad just doesn't want to believe that their child is a criminal.
Yeah, you don't want to believe your child's like a killer or whatever. It's like, it's crazy. And we have a habit, like you get old school investors that like, hey, no, this model is solid. Blah blah blah. This is cheap. This is a value play. I mean, there's clearly something wrong. Should they have been dealt the death penalty? Like, I don't know how that works. In the securities business, they probably would have been. In the banking business, I don't know how, obviously the regulators are willing to deal with each one of these cases on a one-off basis. It's amazing that if I get 3 parking tickets, my fines go up. But if I do 3, acts of criminal negligence in the securities and the financial fraud in the banking business, my fines are looked at as completely independent events that have that don't have no carry forward from previous events. I would say if there's ever been a situation that calls for something a lot more drastic, this would have to be, they are the poster child for that. At least, like I'm gonna go just short of calling them, fraud, because they haven't done. I mean, obviously they've done fraudulent things and criminal things, but they haven't put the base of their investor capital at risk like Silicon Valley Bank did, and like lots of other banks did, by being too stupid to understand. Like ignorance is not an excuse for not understanding the risk you're taking with like yield curve and stuff like that. And I'm assuming that in the case of Wells Fargo, that has not been the topic. But what they've done with creating false accounts and opening accounts for people that don't exist, and giving the wrong numbers to the analysts, and overcharging. A lot of it's overcharging for crazy fees and overcharging for money management stuff. I mean, the whole thing it reeks. And I think that the crazy part about it is there's probably so many damn good people that work at, manage money at Wells Fargo, that work at Wells Fargo, that like the core of like, what do they have? A couple 100,000 people, 200,000 of the 200,005 are probably great. And then there's a couple bad apples that for whatever reason they haven't been able to weed out, which is a huge issue with their corporation. I don't actually know what the answer is, because I'm sure most people are good. I just don't know.
Well, I mean, the argument at Uber was they replaced the CEO and the culture improved.
That's the argument in a lot of places. The CEO needs to be replaced, but always for different reasons. Sometimes it's about culture. Sometimes it's about know-how. Sometimes it's about passion. It's the same in sports. Like sometimes the coach goes down because somebody else on the team did something stupid and the coach looked the other way. Hence what happened at Northwestern with Pat Fitzgerald, or happened on the Blackhawks with Joe Quinn. Not on the Blackhawks, but the Panthers with Joe Quinville. Like they looked the other way when something happened. It's the same Joe Paterno thing. But other times, a change of coach, because you can't change the players. And the same thing at Wells Fargo. You can't change the players, so you change the management team. And the new person comes in, but there's all this stuff that's still, it takes a while to figure it out.
The interesting thing, and I just feel, I'm just thinking about the degree to which, whether it's Volkswagen or Wells Fargo, or even going back, Enron, I really exploited this for a long time.
Well, Enron's fraud. When you have a case of pure fraud, like you can't compare Enron and like.
I guess, but my point, sorry, but even with Enron is the regulators are always they really don't want to put the company out of business. Like they bend over backwards. Like even with Enron, they were like, we really don't want to have to do this. Maybe we'll take out Jeff Skilling. Maybe we'll take out this, but we don't want to. And so I just think that my point is, I think that the bad actors, whether it's Volkswagen or Wells Fargo or who, that they take advantage of the fact that the regulators really don't want to give the company the death penalty.
But they, and rightfully so. The last thing you want to do is put 200,000 people out of business, in a highly concentrated area of America. In this case, the San Francisco area, Northern California, where these guys are. It is ugly, and the regulators do have a responsibility. If you can get the company to change the management and save the jobs, it is important. Like the last thing you want to do also is even push, like the last thing regulators want to do is to make JP Morgan any bigger.
Mm-hmm.
Like they don't want to force everybody on JP Morgan. So then JP Morgan controls the whole damn world. So you want the regulate for retail, for customers that use retail banking services. You want as much competition as possible, and it's very difficult to compete with JP Morgan, and other firms like that. So, so you want people out there other than just JP Morgan and Citigroup and PNC. You need a lot of players out there. So yeah, you don't want to put Wells Fargo out of business, but at what point do you just draw, like, what's the fine, or what's the number? What happens? Or do you demand that they change leadership again? At some point you have to do something. It is beyond ridiculous that this firm can't stay out of the news for bad stuff.
And it's evidence of how challenging it is to find a remedial action that is effective without terminating the business.
Yeah. So the news came out this morning. The news came out on Monday morning, and stocks up today. Was up on Monday.
Meaning that
everybody has, Wells Fargo has basically, done so much. The expectations for what Wells Fargo is capable of are so low that just a $30 million fine is good news.
Yeah, that they're getting that being fined for that's considered a successful remedy for the company.
It wasn't $3 billion.
Yeah, pretty good. Fewer zeros. Good work.
Yes. So congratulations, management team. Fewer zeros. You have negatively impacted fewer people than you did last time. So congratulations, and for that you have your $30 million fine.
All right.
Yeah, listen, that's a very sad commentary on where we are as a society, but again, I'm not going to just blame the regulators, because they're caught, there's a certain expectation that regulators have to have, that firms will act in, with integrity and with ethics. I mean, you can't oversee, you can't basically micromanage, every financial institution, everything that they do. It's impossible.
Yeah. Well, there's got to be a better, that'd be nice. I mean, this is wishful thinking, but clearly the fines don't work. Sending the DOJ to shut them down is catastrophic to hundreds of thousands of jobs. It'd be nice to think there's some sort of a third penalty that's punitive enough to create a remedy without terminating the whole, all the jobs.
And the scary part about it is, if you go around the world, when you do have a concentration of financial services, like, for example, in Germany, you have Deutsche Bank, or in, Switzerland, you had, UBS. You do have, when these institutions just get too big, and they're able to just chew up the competition, they really have a lot of, no regard for competition, and they abuse their privileges, they abuse their power. Corporate power is something that, I mean, I know it's probably, it sounds like it's an overused term, but corporations are bullies. And, it's very rare to find a corporation that like, I mean, I always use Tasty because it's the only corporation that, we're obviously involved in, but we treat our customers like in a crazy fair way, and try to be as, make everything, we try to level the playing field so that everything is horizontal, and nobody is like, no matter how much money you have, it doesn't make a difference. Like, I hate firms that say, well, you have $2,000, you speak to this person, but you have $2 million, you speak to this person. Like, we don't do that. And I just feel like there's so much, like, the whole, world of just the way people treat their customers, and the advantage that, big firms try to run over people and bully people. It's ridiculous. It really is ridiculous. And I don't know how you change that culture other than through, other than making sure that the financial markets are able to finance disruptive startups.
And even, yeah, again, that's enough. I mean, because I would say it's even bigger than that, because the largest corporations, whether it's the German banks or the Swiss banks, or for that matter, JP Morgan, frequently are more powerful than the government itself. I mean, I think that's what you saw in 2008. That's the definition of too big to fail, right? Too big to fail is the government must finance the losses of my company, because if the government does not finance the losses of my company, the failure of my company will be so catastrophic that it is more expensive to the country to allow me to fail than it is for the country to pay for me to exist.
Well, when you have companies that have a market cap that's higher than the GDP of most of the other countries around the world, I mean, Apple has a market cap that's higher than, every GDP around the world except for like 2 or 3 countries. It's insane. So, yeah, these companies are, they've gotten to levels that, they are bigger than countries. They're bigger than zones. They're almost bigger than continents. It's freaking scary.
Although I'll leave you with this. You are speaking of scary and uncomfortable thoughts. I was watching an Elon Musk interview in the last couple of days, and somebody was, the interviewer was fascinated with the idea that he's the world's richest man. He was saying, oh, you're the world's richest man. And Musk was very adamant in cutting the interviewer off and saying, I'm for sure not the world's richest man. And he wasn't talking about like the stock price of Tesla relative to Amazon or Louis the Bernard Arnault, the Louis Vuitton guy. He basically said, no, the world's richest man is Vladimir Putin. He's like, by an order of magnitude of 10 times whatever money I have. This is Musk talking. He's like, you're not really rich until you can mount your own army. He's like, and I still can't mount my own army. Anyway, it was just an interesting perspective. He was diminishing. He was saying, listen, you think I'm rich? You don't know rich. But
he's still
Apple's rich.
He is Dylan Radigan. I'm Tom Sosnoff. This is Truth or Skepticism. We do this every Wednesday at 1 p.m. Central Time. Dylan, that was fun. Have a great week.
I'll see you next week.
All right.
Bye-bye.